Welcome to Breaking News to Trading Moves. Today, we're looking at something that just keeps lingering in the background for airlines, those ongoing supply chain problems, how they're affecting finances, really across the whole aerospace sector.
Yeah, it's definitely still a major factor. And we've got a pretty stark number to anchor this. Coming from IATA data, they're projecting airlines globally could absorb something like $11 billion in extra costs
11 billion just for 2025.
just for 2025. Yeah. And it's really all flowing from these persistent supply chain issues, tight capacity for parts, for maintenance, for new planes.
Wow, okay. That's a huge chunk of change they didn't plan on spending. So let's try and follow that money. Where is it actually going? Who's maybe gaining from this situation, holding the pricing power, and who's, well, fitting the bill?
Exactly. It's like this forced substitution, right? Airlines want new, efficient planes, but they can't get them fast enough, so they're forced to use older, more expensive options. And that's creating winners and losers.
Right. So let's start with the pain. How does that $11 billion actually break down for the airlines?
Okay, so IATA breaks it into roughly four main buckets. The biggest slice, about $4.2 billion, is basically down to flying older jets longer than they wanted to.
Meaning more fuel burn?
Exactly. More fuel burn, that hits the bottom line directly.
Almost half the total just from extra fuel because you're stuck with an older plane. That's quite something.
It really is. Then the next chunk is about $3.1 billion. That's going towards higher maintenance costs. These older planes flying harder just need more work, more often.
Okay, more fuel, more maintenance. What else?
Third, there's a pretty big number, $2.6 billion, being spent just on leasing replacement engines.
Ah, so their own engines are stuck waiting for repairs.
Precisely. The overhaul shops have these really long queues, sometimes waiting for specific parts themselves. So airlines have to lease an engine just to keep the plane flying while their own one sits idle. It's like paying rent on power.
$2.6 billion just for temporary engines.
Okay.
And the last piece.
The last bit is about $1.4 billion. Airlines are basically building up bigger stockpiles of spare parts than usual, trying to avoid getting a plane grounded because they can't find, some routine component when it breaks.
Right, a bigger buffer against disruption.
Yeah. So the overall picture is capacity is really tight, especially in that aftermarket, the maintenance and parts world. And that's keeping the pressure on airline costs probably for a while yet.
Okay, so if the airlines are facing these unavoidable costs, who's actually benefiting? Who's positioned to capture some of that $11 billion spend? Let's look at the financial beneficiaries here. Maybe start with the aftermarket parts folks and the MRO providers. Maintenance, repair, overhaul.
Yeah, that's a good place to start. They're definitely seeing increased demand because, like we said, the longer airlines fly these existing planes, the more maintenance they inevitably need, both scheduled checks and unexpected repairs.
And the spending flows to them.
It flows straight to them, especially to the independent MRO shops and also companies that control key parts.
Let's talk about controlling parts. Why is that so powerful right now? Things like proprietary components.
Well, in aerospace, a lot of components aren't just standard nuts and bolts. They can be really complex systems, often designed and made by the original manufacturer, the OEM, or maybe a big supplier like TransDigm.
TransDigm, ticker TDG.
Right, TDG. They benefit because they make a lot of these high-margin proprietary parts that are essential for keeping planes airworthy. If an airline needs a specific valve or actuator that only TransDigm makes or repairs effectively, they don't have many options, especially when things are tight.
So supply constraint give them pricing power. What about companies offering alternatives? Does that help the airlines?
It can. That's where a company like AKCO comes in, AGI. They specialize in making PMA parts. That's parts manufacturer approval.
Okay.
Basically, these are alternative parts approved by regulators that do the same job as the OEM part, but often at a lower cost. When OEM parts are scarce or delayed, airlines get much more interested in finding reliable PMA alternatives. So AKCO sees demand go up.
Makes sense. And the actual shops doing the work, the MROs.
Yeah, companies like AAR Corp, ticker AIR. Their independent MRO capacity becomes really valuable.
Right.
We mentioned those long shop queues. Sometimes overhaul times are stretching from, say, 60 days to 150 days, or even more.
Wow.
So if an independent shop like AAR can turn an aircraft or an engine around faster, that slot time is gold for the airline.
Okay, let's link this back to the engines specifically. That $2.6 billion airlines are spending on leased engines. Who's capturing that money? Engine lessors, module shops.
Right. So when an airline's engine goes in for that long overhaul, they can't just park a multi-million-dollar jet. They need a replacement engine fast. This is where engine lessors step in.
Like who?
Well, you've got companies like FTAI, Aviation, FTAI. They focus a lot on leasing CFM engines, which power a huge number of narrow-body planes, and the related engine modules. Demand there is very high.
And the big engine makers themselves,
Oh.
GE, for example, are they benefiting from the backlog they're partly responsible for?
Absolutely. Take GE Aerospace, ticker GE. Even with delays on new engines, their existing fleet needs servicing. So demand for their OEM services, their spare parts, it stays really strong. That's often high-margin business, too.
So they make money servicing the older engines while the new ones are delayed.
Pretty much. And then you have pure-play engine lessors like Willis Lease Finance, ticker WLFFC. They specialize in providing pools of engines and components, often on longer-term leases. They help airlines manage that gap between needing an engine and actually having one ready from the shop.
Okay, one more group of potential beneficiaries. The aircraft lessors. Companies like AerCap and Air Lease. It seems a bit odd they'd benefit when new plane deliveries are messed up. Why is that?
It seems counterintuitive, yeah, but it works like this. The delays in new deliveries from Boeing and Airbus mean airlines have to keep flying their current planes longer. They might have planned to retire a 15-year-old jet, but now they need it.
So they extend lease.
Exactly. They're forced to extend leases on these midlife aircraft, planes they might otherwise have returned.
But aren't older, midlife planes usually less valuable? Why would lease rates hold up?
Normally, yes. But right now, the scarcity of any available aircraft, new or used, is propping up the value of existing planes. Airlines need capacity, period. So lease rates stay firm, even for older jets.
Ah, scarcity lifts all boats, so to speak.
Kind of. It means companies like AerCap, AER, and Air Lease AL are in a pretty good spot.
Yeah.
Airlines rely heavily on leased aircraft to keep their schedules running, and the overall shortage just supports the value of their portfolios.
Okay, that paints a clearer picture of who's maybe capturing margin in this environment. Let's flip it now. Who are the cost absorbers? Which carriers are really feeling the pinch from these ongoing constraints?
Well, you could start with the big U.S. network carriers. Delta, United, American.
Tickers DAL, UAL, AAL.
Right. These guys have huge fleets and extensive plans for modernization, getting newer, more fuel-efficient planes. When those deliveries slip, they're directly hit by those higher fuel costs we talked about, the $4.2 billion, and the higher maintenance on the older fleet, the $3.1 billion.
And just because of their sheer size, they absorb a large part of that total $11 billion industry cost.
Exactly. The scale works against them here. Then you have the low-cost carriers, the LCCs.
Like Southwest LUV or JetBlue, JBLU.
Yeah. Their whole model is built on super high aircraft utilization, keeping planes in the air, turning them around quickly. Very efficient, but it leaves them with thin operational buffers.
So a parts delay or a maintenance slot delay hits them harder.
Much harder, potentially. A plane stuck on the ground waiting for a part or a repair crew is a huge problem for their tight schedules. It causes disruptions that ripple through their network and drives up their unit costs very quickly. They just don't have the same slack in the system as a larger network carrier might.
Okay, network carriers, LCCs, any other specific groups feeling the pressure?
Yeah, I'd point to airlines with a lot of wide-body aircraft, particularly those focused on long-haul routes.
Why them specifically?
Because maintaining those big twin-aisle jets, especially the massive engines they use, is just inherently more expensive and complex. Engine overhauls are a huge capital cost.
Right.
So when those specialized engine shops get backed up, the costs really multiply. And the time that a very expensive wide-body jet is stuck on the ground, not earning revenue, can stretch into months.
That's a massive opportunity cost, grounding an asset like that.
It really is. So you look at carriers like Hawaiian Holdings HA or United, again, ticker UAL, with its big international network. They've become particularly exposed because of their reliance on these specific types of aircraft and the specialized bottlenecked maintenance they require.
Okay, so we have this split. Suppliers and lessors potentially gaining margin, while carriers are absorbing these extra billions in costs. For people watching the market, does this suggest any particular dynamics or ways to monitor the situation?
Well, when you see a persistent cost transfer like this, it does sometimes lead observers to consider things like pair trades. The idea is to try and capture that gap.
How would that work here?
You might, for example, look at taking a long position in a basket of those aftermarket and MRO companies we mentioned, maybe TransDigm, EICO, AAR Corp, who seem to be benefiting from the maintenance spend.
Okay.
And balancing that against a short position in some of the carriers who are clearly absorbing those fuel and maintenance costs, perhaps a Delta or a United TIT. The theory is you're playing the cost transfer itself, potentially isolating yourself a bit from broader market ups and downs.
Right, trying to capture that specific dynamic. So, looking ahead, what could actually change this? What catalysts might ease this cost burden for the airlines and maybe signal a return to something more normal?
There are probably three main areas to watch. First, any real regulatory action aimed at boosting competition in the aftermarket for parts and repairs. That could definitely chip away at the pricing power some suppliers have.
Okay, regulatory changes. What else?
Second, obviously, actual updates on OEM delivery schedules. If Boeing and Airbus can genuinely ramp up production and start delivering those new efficient planes faster, that takes pressure off the older fleet.
Makes sense. Get the new planes flying.
And third, we need to see an expansion of engine maintenance capacity, more skilled mechanics, more shop space, more efficient processes. Anything that starts to shorten those incredibly long overhaul queues would make a big difference.
So it sounds like for now, the airlines are kind of waiting for these external factors to shift.
I think that's a fair way to put it, yeah. This whole situation really goes beyond just simple delays. It really underscores the lasting economic value of having that specialized maintenance capability and access to proprietary parts in an industry where just building more capacity quickly is really, really difficult.
That's certainly a key point for you watching this sector to keep in mind as it continues to unfold. And a reminder before we go, this is not financial advice or buy or sell recommendations. This is purely the opinion of the author. Thanks for joining us on Breaking News to Trading Moves.